Hey folks, welcome back to the channel, and we have to talk about Alphabet's stock split today and the opportunity this represents for investors. A stock split is when a company decides to divide its existing shares. Stockholders still own the same portion of the company, but each of their shares are just worth less. In Alphabet's case, it's a 20 to 1 split, which means if you own one share of the company before, now you have 20. For investors, stock splits make shares of the company more accessible as the shares become more numerous and cheaper. And for traders, stock splits create an environment where cheaper shares lead to higher volumes of options trading. And for option traders like myself, this is really good because higher volatility means higher premiums that I can earn. So, if you ever thought about buying some shares in Google's parent company Alphabet, now's the time to seriously consider it. Because, first of all, since 1980, stock splits have significantly outperformed an S&P 500 benchmark index, according to a Reuters report. The average return of a stock split was 25% over the following year, compared to just 9% return for non-split stocks. Another reason to buy the stock today is because Alphabet is down 25% from its highs. The business continues to generate lots of sales, but the stock price just doesn't reflect its strength. And when you have multiple compression, when the stock price moves lower despite stable financial conditions, the future returns tend to be higher. And that's because valuations are inversely correlated with future market returns. So if you had to choose a time to invest your money, you're much better off investing after a major decline than just any random time. But of course, none of that matters unless you have a top quality company to invest in the first place. So let's answer the question. Is Google or Alphabet a high quality business that is expected to grow its earnings for many years to come? I believe the answer is a resounding yes. Let's take a look at the financials here for Alphabet, going back all the way to 2006. You can see the revenues per share just increasing pretty much every year, and you're getting that double digit growth. Earnings per share, or EPS, one of the most fundamental metrics to track in terms of pricing a stock. You can see very high growth rate over time. Free cash flow, similarly, growing all the way from $2 a share to now we're at over $100 per share just over the last 15 years. Very impressive to see, and no signs of slowing down. I still expect Alphabet to grow its top line as well as bottom line by 20% a year for the foreseeable future. It also has one of the best balance sheets with very little debt and has strong gross margins and free cash flow. And it consistently has a return on capital above the industry standard, suggesting very efficient use of capital within the company. In terms of competitive advantage, well, Google has a very wide economic moat, and this protects it from competitors. Uh, Alphabet has many different products used by over 1 billion people worldwide, and these take advantage of the network effect, where the more people use something, the easier it is to attract new users. And it's quite difficult for other companies to enter the search advertising space, which is still Alphabet's main bread and butter. And all that sounds very good. So, what about valuations? Well, there's good news here as well. The stock is trading at less than 20 times price to earnings. This almost never happens. Looking at history, we can see the PE ratio has typically been much higher, and the 5 year average is around 33 times. Anytime it drops below 20 times PE, I think it represents a significant discount. Now, you might be saying, well, interest rates are higher now than they were a few years ago. So, don't we have to adjust for a higher discount rate? And that's a fair point. So, let's take a look at other times in history where interest rates are higher. So, this is the Fed funds rate going back to before 2000, but Google IPO'd in 2004. So, just looking after that, between 2005 and maybe 2008, you had interest rates above 2%. And then also in 2018 and 2019, interest rates were also above 2%. So that's kind of around where the interest rate is at today. So let's take a look at those time periods for Alphabet. We can see 2006, 2007, 2008, the PE ratio during those years were much higher than they are today, pretty much double. And you can see at that time it was even more than 2 times the PE ratio of the S&P 500 index. And also going to 2018, 2019, during the interest rate increases right before the recession in 2020, we can see that the P/E ratio is 25 and 24. Again, that's higher than today, which means even adjusted for interest rate, Alphabet is trading at a relatively low valuation today. So personally, I already own some Alphabet stocks, but I'm looking to add more to my position because of all the points I touched on in this video so far. And there's a few ways you can gain long exposure to this stock. Investors can simply buy the shares, which they're more accessible now than before. And anything is possible in the short term, but I would say over the next 1 to 2 years, it's hard to imagine Alphabet stock being lower than it is now. But another way to play this stock is to use options, and I think there's potentially more gains to be had here. So if I go to my brokerage account and open up the options chain here for Alphabet, I can see that if I go over to the put side, I can sell a out of the money put. So one standard deviation away is this one here, and I can sell this put and make about $47. And then I can also go down here on the call side down to about 17 or 117 or 118. And then I can sell a call option. Now I have 100 shares of this company already. I had 5 before today, and then the 20-to-1 split basically switched 5 for 100. So if I sell a call here, it would be a covered call. And let's say I go for about one standard deviation away as well, maybe choose a 0.15 or so delta. I can sell that. So this will give me a short strangle. And if I choose the mid price, let's say 85 cents there, and submit, you can see I can make an $85 credit. So that's the money I would earn from premiums. And all I need for collateral is $38.78. So if I do the math on that, $85, well, let's say $83 because there's commission involved. So net credit of 83 divided by 3,878, that gives me a 2.1% return in just 1 week. And if I multiply that by like 50 weeks, let's say a year, then that's, times 100, that's a 100% return over the course of a year. I actually think that would be quite an interesting experiment. So let me know if you want to see weekly updates where I sell weekly options on Alphabet and then track my progress and see if I can get to 100% return over the next year or so. I think that would be quite a fun challenge. So this Alphabet stock split, it's a great day for investors. It's a great day for traders. And if after you do your own research, you come to the same conclusion as me, which is that Alphabet is probably one of the best publicly traded companies you can buy with money in terms of getting the best value for your dollar, then I think it's definitely worth considering buying some shares or trying to get in with some put options into this name right now before the stock goes up. So that's all I have for now. Thank you for watching. Happy investing, and I'll talk to you in the next one.